ELI5. Stock Market Megathread. There's a lot going on in the stock market this week, and both ELI5 and Reddit in general are inundated with questions about it. This is an opportunity to ask for explanations for concepts related to the stock market. All other questions related to the stock market will be removed and users directed here. How does buying and selling stocks work? What is short selling? What is a short squeeze? What is stock manipulation? What is a hedge fund? What other questions about the stock market do you have? In this thread, top-level comments, direct replies to this topic, are allowed to be questions related to these topics as well as explanations. Remember to follow all other rules, and discussions unrelated to these topics will be removed. Please refrain as much as possible from speculating on recent and current events. By all means, talk about what has happened, but this is not the place to talk about what will happen next. Speculate about whether stocks will rise or fall, whether someone broke any particular law, and what the legal ramifications will be. Explanations should be restricted to an objective look at the mechanics behind the stock market. Edit. It should go without saying, but we'll say it anyway, that any trading you do in stocks is at your own risk. ELI5 is not the appropriate place to ask for or provide advice on stock buy, selling, or trading. Hopefully this is helpful. I work in the stock market and my little brother asked me to explain what was going on. Here was my response. Let's say GameStop has 100 shares outstanding currently trading $20 per share. So if you own 1 share, you own 1%, 25 shares 25%, and so on. That's it. There are only 100 shares of GameStop. Throughout the day people are constantly buying and selling these shares for one reason or another. That's why the stock price moves up and down constantly. Now, typically when you think about making money in the stock market you typically think, buy low, sell high. In other words, buying Amazon when it was cheap, and now it's worth. In this case you would be speculating that the stock price of Amazon will go up in the future. Fun industry term. You are bullish. Here is where the short selling comes into play. Let's pretend you have a hedge fund. Alex, hedge fund manager, looks at GME, GameStop, and says, I think GME is overvalued. It really should only be trading at $15 per share, not $20. In this situation, he is speculating that in the near future, the GME stock price will go down to $15, another fun industry term. He would be bearish on GME now. Since the hedge fund manager thinks GME's stock price will go down, he is going to try to make money on that guess by short selling, shorting the stock. To short the stock, the manager is going to borrow some shares from someone else, Bob, and sell them at the current market price, which is $20. Let's say he borrows 10 shares, total of only 100, remember, and sells them at the New York Stock Exchange for $20. He made $200, $20 x 10 shares. A while later, GME's stock price suddenly dips, fun industry term, down ticks. It is now trading at $15. Alex, hedge fund manager, was right. Now don't forget, we borrowed the shares from somebody else, so we have to give those back. Alex, hedge fund manager, goes to the New York Stock Exchange and buys 10 shares $15 and returns those to the lender. Alex, hedge fund, made $50 on that trade total. This is called P&L. So the full life cycle: borrowed 10 shares from Bob, sold 10 $20 in the market, bought 10 $15 in the market, returned 10 shares to Bob. Total profit: 10x $20, 10x $15. Okay. So now on to what is actually happening with GameStop. Let's keep the example the same. GameStop has 100 total shares outstanding. Now a bunch of hedge fund managers all think the exact thing that Alex, hedge fund manager, thought, so they all short the stock with the expectation that the price will downtick in the future. Here's the thing. Someone on Reddit pointed out that despite the fact that GameStop only has 100 shares available at any given time, there were actually 125 shares on loan to cover short sales. I know this part is confusing, which it should be. That doesn't make sense mathematically. How can you have more shares loaned out than available? I'm going to gloss over those details and just say that it is possible, and does happen on occasion. Now when you have a stock that is overshorted like this, you have one major risk, which is called a gamma short squeeze. It does not occur often. In a gamma short squeeze, there are more shares loaned out than available. That is because all of those hedge fund managers thought the price would go down and got greedy and tried to make as much as possible and overborrowed, assuming they would be able to cover it. But Someone pointed that out on Reddit, and was able to get that information to go viral. Now with all of these new people buying the stock, it forced the stock price up, very quickly, supply and demand. Just like in the example, these hedge fund managers had to return the shares to the lender. The problem is, the stock price has gone up so much that if they have to close their position, they'll lose a fortune. Example. I sold $10 $20 $200 instead of going down. The stock price went up to $400. I have to return the stock to the lender and the only way to do it is to go buy it back. So, I buy $10 $400 $4,000 PNL plus $200 $4,000 instead of making money. I lost $3,800. This is basically what is happening with GME on a much bigger scale. Edit 1. Lots of people asking about the loan. It's not really a loan in the way that you're thinking. When you execute an order to sell a share, you are required to mark it as either long or short. What this really means is, do you have the stock right now in your bank account, or are you able to get it easily? So theoretically, everyone could be marking their orders as short sales, assuming the shares are easy to borrow and readily available. Except, as the price goes up, people panic and start buying them all up and there aren't enough to go around. This in turn drives the price up further. Hence the squeeze. Typical settlement of a trade occurs T+2. In other words, you're required to deliver the shares you sold short to the counterparty within 2 business days of execution. Edit 2. For those asking about option expiration, an option is like a coupon. It gives the coupon holder the right to buy or sell stock, at a given price, on a given date. Think about it this way. If I think that the stock price of GME is going to go up in the near future, I can buy a coupon, technically a call option, that gives me the right to purchase the stock for a set price at a later date. So if GME is $20, I may buy a call option that gives me the right to buy GME stock for $20 per share exactly 1 month from now, expiration. The idea is that within that time frame, the GME stock price will increase, thereby making my coupon valuable because it allows the owner to buy at a discount. On the other side, you have someone who writes the contract. Essentially sells you the coupon. Let's say GameStop is trading at $20, and you buy that $20 coupon. Well now, GameStop is trading at $400. So if your expiration is tomorrow you can exercise it. And the writer is required to deliver your shares for the agreed upon price, $20. To do that, they'll probably have to go out and buy it at these exorbitant prices. Okay, let me get this straight. I'm Wall Street and I borrowed a pillow. Have to give it back on the 29. Sold the pillow for $100 thinking I can buy it back for $50 before the 29. Reddit bought the pillow I borrowed and now I can only buy it back at $3,000 tomorrow is the 29 and I don't have $3,000. I'm screwed? Correct, except you borrowed and sold off more pillows than actually exist in the universe. How does buying and selling stocks work? I own an orange factory. I want to raise money for building a new naval orange machine, so I issue orange stock. I make a special orange that you can buy for $1. I issue 1 million oranges, and raise $1 million. You now own an orange for every $1 you gave me. That's all you get. If you're lucky, I might give you a fraction of how much I make with the new orange machine every year. But you buy the orange share because other people will want it later, when my company is big and successful, and you can try selling the orange share for more than the original dollar. What is short selling? You have 100 of my oranges. I come up to you Monday and say, if you loan me those 100 oranges, I will give you $2 and your oranges back Friday. You agree, and I go off and sell your oranges for $1 each. I have $100 and owe you $2 and your oranges back. I hope your oranges will be cheaper Friday, and if they are only worth 50 cents, I buy 100 oranges and give you them and $2, and I am $48 richer. What is a short squeeze? Someone saw me make the deal on the oranges, and then immediately sell them. They know I have to have 100 oranges on Friday. So they go buy up all the oranges, and on Friday, when I try to buy oranges, they are standing there with a sign that says oranges for sale $20. Anyone who wants to sell oranges is selling them there. I have to buy from them for $20 an orange. Now I have lost $1,900 buying the oranges back, and still owe the $2. What is stock manipulation? When I buy the 100 oranges, I go around and talk about how bad oranges are. I tell my friends not to let anyone buy oranges so demand drops. I go on CNBC and talk about how I bit into a nasty orange and threw up. Now oranges are 25 cents. How wonderful. I can buy my 100 oranges for $25, and now my profits are $73. I just want to know what happened with GameStop. Edit. I've received so many good answers and I thank you all. I've never received so many good answers before. In an as neutral and concise as possible manner, and I may have missed some things. GameStop is seen as a company in trouble. Their business model of brick-and-mortar stores for game sales and rental is under pressure due to people using downloads instead more and more etc. etc. This was picked up on by some hedge funds who thought that the company would face bankruptcy in the near future, which would render their shares effectively worthless. So they bet against GameStop by shorting their shares. Shorting shares is the practice of borrowing shares, selling them, waiting for the price to go down, buying them back at a lower price when that happens and giving them back to the lender. It's buy low sell high, in reverse order. Rather than betting a stock will rise by buying it now and plan to sell later when it's worth more, you sell now and plan to buy later when the price is lower. Then two things happened. GameStop reorganized. New CEO, closed the worst stores, effectively tried to become smaller but more importantly profitable again. 2. The Internet, notably WSB, picked up that an enormous amount of GameStop shares were sold short, to the tune of 120% of available shares. Currently. Now two important things come into play. 1. When you borrow a share, the contract will specify a date by which it must be returned. 2. When you buy a stock, the most you can lose is the value of the share. You buy shares for $1 million, company goes bankrupt, share becomes worthless, you lost your million. You cannot possibly lose more. When you go short, however, if you short sell 1 million worth of shares, your potential loss is unlimited. If the value of those shares tripled to 3 million, you now owe 3 million worth of shares to the lender. If it triples again to 9 million, you now owe 9 million worth of shares. Short selling is inherently risky that way. In comes WSB. They figure that maybe if enough people can be convinced to buy GME stock, first the price will naturally rise if enough people want to buy, and secondly, well, one day those short sellers will be forced to buy them at market price, and if a lot of them have to do so, the price should rise spectacularly because the short sellers must buy. GME stock indeed started to rise. Spectacularly so. Worth $10 a few months ago, it went up to $384 yesterday. GME is worth $13.5 billion right now. It was worth more like $0.5 billion a few months ago. With the company having been short sold 1.2 times, that means there are red numbers on the short sellers' books right now for about $15 billion. If they effectively do need to return a large amount of borrowed shares simultaneously, they will need to buy them, driving the price even further up, and every the share price goes up, that $15 billion in the red also goes up by about 1%. I will not speculate on what will happen further, but the biggest similar thing I've seen happen when I worked in that world was a somewhat similar scandal in 2005 where a single bank lost around $220 million in a single day. Heads, big heads rolled then. I am honestly anxious to see what the future will bring with all this. Edit. I won't edit the above so the many comments keep making sense. First of my thanks for the many replies, awards and upvotes. Especially those comments that pointed out some mistakes and inaccuracies in the above. Secondly, the CEO did not change, but GameStop did attract a number of new board members who were pivotal in turning another company in a similar situation, needing to transition from brick and mortar to much more online, around. This obviously gives hope that GameStop could possibly be turned around and be profitable again as well. Thirdly, I assumed that lending contracts had expiry dates, just like options trades, because of WSB insisting that today is a pivotal date in all this. I was mistaken, as it turns out lending and borrowing is only limited by collateral put up, not by expiry dates. Lending and borrowing is not a part of the exchange I specifically worked on, options and futures were my niche. A part of the puzzle I missed is that apparently those same and/or other hedge funds betting against GameStop also wrote a lot of uncovered call options, the more traditional way of betting against a company, and those do, or at least some do, expire today, which is where the squeeze for specifically today comes from. This means that the closing price for GME tonight US time will be extremely important in how all of this shakes out. The higher it closes, the more massive the carnage will be. This thing is even more high stakes than I at first suspected, it turns out. Jordan Belfort said this was basically a modified pump and dump. Why or why not is that an accurate description of what's going on? People aren't buying GME because they believe so much in GameStop, at least I'm pretty sure of that. It's purely a money-making scheme. And they have to sell all these shares at some point to make their money. Otherwise it would be a pointless exercise. Or is the actual goal to bankrupt the hedge funds? So they get everyone excited, stock shoots up, the smartest people sell at the top, everyone else gets screwed. Isn't that what's going to happen here? Edit. I've gotten a bunch of good explanations and conversations on this. Basically, the action looks similar to a pump and dump because the price is being forced up, but it's really about screwing the hedge funds that were shorting stocks and overselling. So it's not an effort to hike the price and get out quickly, but to hike the price and force the hedge funds' hands. It's not about making money off of it. Of course, plenty of people will make some money, and lots have been talking about everyone getting rich off of this, though I don't really see that happening. For everyone. Bonus edit. I want to clarify that those are the purported reasons for why this is not a pump and dump. It's hard to say the real motivations of the people that started this whole thing without actually being in their heads. Everyone should have some critical analysis of complex situations like these. Super extra bonus edit. Check out this video from way back in July by the man that, apparently, started it all, aka you, deep fucking value. This guy has been in on GME for a long time because he seems to have actually believed in GameStop. I'm still not completely clear where the shorting hedge funds come into play. I haven't fully watched the video because it is quite long, but it seems like it's a real mix of different things coming together at the right time for this crazy shit that's happening right now. What will happen if the Melvin hedge fund cannot buy back the GME shares? Can they file for bankruptcy as an organization? Or should each individual associated with the fund do that? If they declare bankruptcy, what will happen with all the shareholders who lent them their shares? Will they lose them forever? This is oversimplified, but they essentially had to post collateral to borrow the GME shares to short. As the price kept going up, they should have had to, in theory, post more collateral. I don't know how much of their total assets the short position represents, but basically they would have to sell other assets to fund the repurchase. In theory, the people that lent them the GME shares would call in all their collateral before it ever got to a bankruptcy situation. The claim that they have closed their position already, but no one really knows for sure. Basically right now it is a game of chicken. People who are buying GME are waiting for all the short sellers to be forced to close their positions by buying GME. People who are short GME are basically trying to outweight the people who are long. People who are short GME are basically trying to outweight the people who are long, which is rather humorous.